What is up, you guys? So in this video, we're going to be going over how to invest in growth stocks at a value and what my personal checklist is for when I'm looking into companies that, qualify as a growth stock. For those of you that are new to my channel, my name is Dan, and this is Millennial Investing. I go over tech and finance topics and kind of go over like financial literacy for younger kids, like college students especially. So that's kind of it. So if you like those topics, make sure to stick around and hit that like button and subscribe. But without further ado, let's jump into the video. So the way I go about investing in growth stocks is derived mainly from the investor Peter Lynch. Now, I've talked about him numerous times on my channel, but for those of you who don't know who he is, Peter Lynch is an ex mutual fund manager that used to manage the Fidelity's Magellan Fund. And he was an investor that over this 13-year period of time was able to average about a 29% compounded annual rate of return. And so you can think about that as that, say if you gave him $1 at the beginning of his time managing that fund, you would walk away with $28 when he retired. So obviously he has an amazing track record. He has, for that short amount of time, he has one of the best track records and best growth times over any other fund manager, hands down. And during his time, he went through 5 different recessions. So he's obviously not just he got lucky because he was in a bull market and then he kind of rode it out and then he left. At that time, he was someone that time and time again was beating the market and was beating the market as it was going down. And he only lost out to the market in 1 year of his 13-year reign. So, so that's why, he's my personal favorite investor. He's a very down-to-earth kind of guy. And he explains how his approach of investing can be adapted by just about anybody. And, through reading all of his books a couple of times and really, giving my opinion on, kind of how things have changed since, like the 80s. So the number one thing to look for when you go to invest in a company, especially a growth company, is the story of the company. Most people, when they go and they buy a stock, they just kind of look at like, okay, this is its share price. Hopefully it goes up. I like this company, it seems good, or okay, people have said good things about it, and they just hope for it to go up. But you really have to make sure that the story of the company that you're invested in is the best story of its competitors, otherwise it's going to slow down its growth and it's going to lose out in the long run. And so what I mean by this is that you have to look at, say, an industry at a time. You have to figure out what industry you want to focus on, figure out all the ins and outs of that industry, and then figure out the main players in the industry. And then once you have a good gauge of where everybody is, you have to figure out, okay, who's doing things the best and who has the most room for growth. And, kind of going through all that, you have to kind of sift through a lot of companies. And generally, you're going to look at every 10 companies you're going to get like 1. And, so per industry, normally, you're only going to get like 1 to 2 picks, depending on how much time you spend on it. But based off of those picks and based off the story, you're assuming, based off of its track record and based off of what's going on currently with the company, that it's going to have the best story that's going to persist over time and lead to the best company. So that's kind of what it means by, what I mean and what Peter Lynch means by, gauging the story of the company. Another thing that you really have to look about is earnings per share growth. Now, when you're growth investing, you have to understand that the majority of other growth investors are looking at, 3 main things. They're looking at revenue, they're looking at EPS, and they're looking at guidance. So guidance is probably the thing that'll be most volatile for a stock, because generally, most good companies can gauge how much they're going to make, quarter to quarter. And, they'll give you projections on the last earnings to kind of gauge for it. And so when they tell you that, okay, things are going to look bad or things are looking great, that is, kind of the biggest button to get growth investors to either buy or sell out of a stock. So you really need to look at, okay, what's its EPS growth? How stable is it? So Peter Lynch, for example, never liked investing in any companies that annual EPS was growing at larger than a 50% rate, because that's realistically unsustainable. But you don't want it below, say, 20, because that's when you hit the, the very slow grower and like steady companies that, yeah, they'll be here for a long time, but the majority of their run's over. So you really have to look at what their EPS is doing, look at how it is compared to their competitors, and then also make sure it's realistic. So, if you only have like 1 quarter and EPS went up 70%, chances are it's not going to continue 70% for the next few years. But, over the last 2 years, if EPS growth has been 20 to 25%, and, it's growing margins nicely, and, say the income and everything else is going off in the proper direction, that's generally more of a safer bet to that this growth is going to continue. So that's something to keep in mind. Next is debt and equity. So Peter Lynch, and kind of my biggest takeaway with him, is that we never like to invest in any company that has a lot of debt, mainly because I'm going to butcher the quote, but Peter Lynch roughly said that, if you invest in a company that has no debt, you don't have to worry about the company going bankrupt. They'll lose customers, they'll lose revenues, they'll cut jobs, it'll be really bloody, but until management decides to, like, say, disband the company, they can never go bankrupt because they don't owe money. So especially in today's current situation where a lot of companies have, more debt than their assets, the biggest thing that I look for in any balance sheet is definitely the debt to equity and the current ratio. And the current ratio is just how much of, the income streams are able to pay off the existing debt if it has any. And, I generally like things that are above, the current ratio is above like 1.5, especially in the growth space, because you have to realize that, okay, whenever a downturn does come, is this company going to be able to keep its doors open even if its revenue, say, gets cut in half? So that's something that, you have to preserve your capital, and you have to make sure that your company is going to be, persistent for the long term, so that way you can really, gain all of the growth along with the company over the long term. Peter Lynch's best picks, he said, were, in his 5th to 6th year. So you have to be willing to gauge that amount of time frame. And, if this company's, barely, they're growing, but they're barely keeping their doors open in one of the best bull markets ever, chances are if the economy goes down, they're not going to be around for long. So make sure to keep that in mind. And going on the other side, you have to really look at their value in comparison to their competitors. So oftentimes, when you do growth investing, when you start to look into a company, you need to start looking to the competitors and kind of like, okay, what are they doing that's different? And oftentimes, if you look into a company deep enough, you're going to find that one of their competitors is beating them on, almost every mark. And that's actually the company that you wanted to put your money into. So, you can't fall in love with a stock because you have to make sure that in comparison to their direct competitors, that they're definitely the best. So, like, you can't say like, oh, I want to invest in stock A no matter what. Stock B may be, like 5% better here, 10% better there, da-da-da. But this company, I just love it so much more. I'm going to go with it even though it's not growing or not sustaining as fast as, its competitor. And that generally, leads to, okay, a lot of people shift to, say, company B, company A falls out of favor, and there you go, their growth stalls, and then most of that value that you were looking for is gone. So you really have to make sure that in a comparative way, your company is going to be the best growth pick and the best long-term story. And again, kind of going back to what I said earlier with EPS, is you have to make sure it's realistic. Yes, like you can take Facebook, for example. So Facebook was growing at above, 54% in revenue a year. And, it was firing on all cylinders and everybody just kept dumping money into it. But you really have to take a step back and look, okay, yes, Facebook's growing a lot of money. It's getting a very large market cap now. How much of this is going to keep going? I personally think Facebook will be growing at, easily 20% for the next 5 years. But people that thought, when you saw Facebook take a massive dip, it thought it was going to grow at 40 to 50% continuous for, another, 5-10 years. So that means that, this company would have had 15 to 20 years of monstrous growth. And that's just unrealistic. And that's generally why you want to stay away from really, really hot stocks, because the optimism gets a little bit carried away a lot of the times. But, if they're stable growth, and you can see that growth being, consistently stable for, good and bad times in comparison to their competitors, it's definitely a good, definitely a good place to start when you're seeking, like realistic growth. And, you can't get enticed by, just awesome numbers, but very short-lived time frame for those numbers. And above and beyond is the PEG ratio. Now, so the PEG ratio is kind of the way that you can make sense of, say, tech companies and other companies that have kind of inflated earnings, PE numbers, or like earnings per share. And a lot of that's, especially in the tech space, that generally has higher PE ratios anyways, is because, they're taking a lot of their earnings, they're taking a lot of their income and putting it into, their research and development in order to stay competitive to ensure that they still grow. And that lowers their actual retained earnings, which makes their PE number much higher on average. And so what the PEG ratio is you take their earnings per share and then you divide that by the earnings, the growth of the earnings per share. And that kind of gauges, you know, in the sense of how fast it's growing, how overvalued is it. It's much better, especially for faster growth companies, than the PE ratio is, because, you know, it could be, okay, my PE is at, you know, 50%, but I'm growing revenues for the past 4 years at, say, 35%. And, you know, having a PE for that amount of growth in say, like the 50 range isn't that unrealistic. And so its PEG might be like a 1 or 1.2. And as a rule of thumb with the price to earnings growth, say a 1, in the ballpark of a 1, is fairly valued for the amount of growth it's going. So you're assuming that this growth is either going to continue or grow up if you invest in that range. If it's below 1, it generally means that they're undervalued in their growth aspect. So you need to look for like other reasons why that amount of growth is getting discounted. Maybe people don't believe it's going to continue. Or like look at Micron, for example. Micron is an extremely low PEG, but that's because, you know, people discount the semiconductor space because they assume that, okay, this is going to be cyclical, and when the next downturn comes, a lot of that growth is going to be cut. On the other side, if you have a company that has a PEG above, say, 2 or 3, that means that so much growth is already priced into that, you know, that share price. You need to have 5 years of complete, like, upset numbers that will just blow all analysts out of the water and, you know, can justify that amount of, you know, growth already being factored in. So, I mean, like, you can look at, like, Amazon. Amazon's kind of, you know, the weird outlier to most metrics when you look at stocks. You know, they just beat their last earnings report. They beat analyst expectations by, I think, a couple multiples, because analysts had no idea how to gauge how much earnings that they were going to do, now that they're kind of focused on making money now. So who really knows with companies like Amazon? But Amazon, you know, has an extremely high PEG ratio, and a lot of like the really big hot names in the tech space have really high PEGs. And that's normally, you know, because so many people are bullish on the companies, they're just factoring in as if this growth is never going to stop. And while those companies, yes, can keep growing for years and years, and you can maybe get, you know, 1 or 2 times your money out of those companies, if you're going for the long term, and if you're going like, if you want that growth to persist after, say, the next recession, and you don't want a significant drop in price whenever there is a recession, you know, it's smarter to stay away from companies with really high PEGs. Now, obviously, each industry is different, as in each industry is different with their price to earnings ratio, but you really need to make sure that the PEG is in line. And that's actually like, Peter Lynch kind of coined that ratio, because, you know, he was a value growth investor. He wanted to make sure that what he was doing was proper. And if you just looked at things at a normal benchmark, you know, people like value investors would see, you know, price to earnings ratio of 40 and then throw the stock away. And then Peter Lynch would go in and be like, okay, well, yeah, they have a PE of 40, but their PEG is only like 0.7. So yeah, I imagine that this is, you know, like actually undervalued, even though it might look overvalued on the surface. So obviously you got to keep digging deeper. You know, this is just a rough checklist of, you know, kind of the things that I've taken away and really applied to my personal investing from Peter Lynch. And, you know, I found these things to be extremely important. And if any company doesn't go through all these, I just kind of cast it aside and like say, maybe I'll go back to it later. And like, obviously there's a lot more analysis that needs to be done whenever I make an investment. But this is kind of the rough, you know, just kind of sifting through companies and just kind of being like, okay, so from these 30 companies, I'll take it, you know, a couple steps further and like really get into like, you know, their 10Ks and, you know, where the company's going management wise. This is kind of my look into their financials and, you know, their brand as a whole, and being like, okay, how much growth can I expect from this company and how much of that's already priced in? So that's it for the video, and I hope you guys liked it, took some, you know, points out of it. Again, I'm not a financial advisor, but, you know, this is kind of taking right out of Peter Lynch's books and me applying it, so that's kind of what you got. So I hope you guys liked the video. I'll see you guys in the next one. Make sure to like and subscribe. Peace.